So income property, why do I think it's the most historically proven asset class in the entire world? Well, it has multi-dimensional characteristics. Most investments, if you're buying, say, precious metals or cryptocurrency, Bitcoin, or non-dividend paying stocks, right? The whole game, the entire strategy of that investment is buy low, sell high. That's it. That's the whole game. Okay. Now, say a dividend paying stock, then the strategy is buy low, get some dividends, and sell high. There's your winning strategy. But income property is a beautiful multi-dimensional asset class. Many have said over the years, and this is way before my time, that it is I.D.E.A.L as an acronym, because it provides you with income, depreciation in a good way, meaning a tax benefit of depreciation where amazingly, you can be winning the game with income property. You can be making money. Your property can be going up in value. And the IRS might still give you a big, giant tax deduction. That's incredible, right? Depreciation, equity growth, appreciation, and leverage. But the thing they didn't talk about here that I'm going to add to this today is something I call inflation-induced debt destruction. And I got some brand new stuff to show you about that. So if you've heard me talk about this over the years, you haven't heard it all, because today there's some new stuff. So you want to think of this like an iceberg, okay? We all know that most of the iceberg is below the surface of the water. And above the surface, we only see a little bit of that iceberg. With income property, what do we see above the surface of the water? Well, we see appreciation and income, right? We know we're getting rent every month and the property is going up in value, for example. But what we don't see, a lot of the stuff is below the surface of the water in the bigger part of the iceberg. And it is a multi-dimensional asset class that gives us incredible, incredible power over other investments. It just has these very special characteristics that other things don't have. Let's talk a little bit about the current market. So the current market, and really starting about 3 years ago, well, there have always been doomers that said the market's going to crash. But 3 years ago, when the interest rates spiked and we saw the highest, fastest increase in interest rates in the history of the country, 3 years ago, post-COVID, when they finally started hiking them, everybody, all the so-called experts said the market was going to crash. And I said it would not. And I was met with the most vociferous arguments from people that said I was wrong and that the market was going to collapse and that nobody could afford to buy a house. And they weren't completely wrong in their assessment or analysis, but they were very wrong in their final prediction of where it was going. And I said the market wouldn't crash. And the reason it wouldn't crash is due to limited inventory. In order to have a real estate collapse or crash, there is one absolutely, positively necessary ingredient you must have, without which there can be no crash. And this one ingredient you must have is tens of millions of distressed homeowners that become millions of distressed home sellers. And right now, and for the last 3 years, we have the exact opposite of that. Why? Well, I started talking about this before the media gave it a name, and now they've named it. It's called the lock-in effect. And what does that mean? It means that so many people have these incredibly cheap mortgages that they got during the COVID era that they simply don't want to give them up. It's too good a deal. Their deal is so good and so desirable that they will just not sell their homes. And so far, this has panned out to be true. I mean, some of them are peeling off slowly and selling their homes, but it's a very small number. And that is why inventory, even with low housing affordability, in fact, the lowest housing affordability in 4 decades, why inventory remains so low, because there are 2 classes of people. There are those who want to enter the market and buy a house, and they're finding that house to be very unaffordable. And there are those who already own a house, and they're finding the house they own with their low rate mortgage to be extremely affordable. In fact, it is so affordable that I did a research project on this. Because one of the things that the doomers were saying to me is they were saying, well, Jason, you say all this now, but just wait till the layoffs begin and unemployment goes through the roof. They always think everything's collapsing, right? This is the way these people think. Then there were some layoffs, right? A lot of the tech companies laid people off. They really overhired during the COVID era. And so they were just sort of right-sizing their companies. But regardless, there were some layoffs and there might be more layoffs. But here's the research I did. I jumped on Zoom with one of the lenders, mortgage brokers that we've worked with for many, many years. And I said, I want you to share your screen and I want you to open up the underwriting software you use to approve someone's mortgage loan. And he did that. And I recorded the whole thing. And I said, here's the example. I want you to assume two people, a couple, are only collecting unemployment insurance from the government. They're on unemployment. They've been laid off. They have no job. And they have some sort of typical debts. They got a car payment, student loan, some credit card debt. And based on their small income from unemployment and their debts, what is their debt to income ratio, or DTI as they call it? Would that allow them to qualify for the mortgage they already have? And the answer was a resounding yes. So what is the mortgage they already have? Well, this chart is a little bit old, but the numbers are almost exactly the same. I mean, they haven't changed much at all. About 24% of the country has a mortgage at or below 3%. About 65% of the country has a mortgage at or below 4%. And remember, even since interest rates have gone up, home prices have still been going up, amazingly, to most people because of limited inventory. And these people just don't want to give up these cheap mortgages. Their deal is way too good. So that's what we have right now. And that's how all the so-called experts got it wrong. Because what has to happen for prices to come down by any real measure is there has to be a lot of distressed people that start dumping their homes on the market. And so far, our inventory has been going up a bit. In fact, it's significantly higher than it was last year. But historically, compared to what? It's still very low. We need to be at what most experts call regular or normal inventory. We need to be about double what we are now in terms of housing stock that's for sale. We have just about 0.5% of the total housing stock, almost 140 million homes, is actually for sale, just over 700,000. And it's ticking up a bit. But again, it's still not enough to cause any huge price movement. You're seeing some softening for sure. And it depends on the market. It varies. But overall, nationwide, prices still going up moderately.